Welcome to the Deep Dive. Today we are focusing on Legacy Housing Corporation, ticker LEGH. We've just done a deep analysis of their Q3 2025 earnings call, which was quite an event. It dropped intraday on November 10th.
Yeah, event is the right word.
This quarter delivered, I think, one of the most volatile narratives we've seen in the housing space all year. You had this stunning financial miss. A massive profit reduction that just hammered the stock. And that was immediately followed by a really aggressive and, frankly, very necessary strategic reset. We're talking about the company's original co-founders, Kenny Shipley and Kurt Hodgson, coming back to take day-to-day control.
It was corporate whiplash. The market reaction was, exactly what you'd expect to a huge earnings miss. Heavy selling, extreme caution.
Right.
So our mission in this deep dive is to figure out what caused this profound profit drop. And then more importantly, to assess whether the founders' turnaround plan is actually credible. They're promising immediate relief in Q4 and an even better Q1 2026.
So it's a story about credibility as much as it is about the numbers.
Exactly. It's about execution, leadership, and a pretty radical strategic pivot.
Okay, so let's start with those cold, hard numbers that really kicked off the crisis.
Yeah.
The headline figures definitely caught everyone off guard.
They absolutely did. Legacy missed on, every key metric. Diluted GAAP EPS came in at just 35 cents.
35 cents, and the consensus was what?
The S&P Global consensus was 58 cents. So that's a nearly 40% surprise miss. It just signals a severe deterioration in profitability during the quarter.
And I'm guessing revenue couldn't save them.
Not at all. Net revenue was about $40.5 million, missing the $45.5 million consensus target. That's also an 8.6% decline compared to last year.
So revenue down, profit way down.
And that pain just flowed directly down the income statement. GAAP net income was $8.6 million, which is down a massive 45.3% year over year.
Wow.
Think about what that does to your margins. Net margins compressed sharply, falling from a really healthy 35.7% all the way down to just 21.4%.
Oof. That kind of drop demands an explanation.
And we got several.
So that margin story, that's the critical path here. If we want to understand where the profit just vanished, we have to look at their product gross margins and these runaway costs.
Exactly. The core issue was margin compression, specifically in their product division, where they actually manufacture and sell the homes. Product gross margin fell roughly 900 basis points.
900?
Yeah. It landed at 20.3% compared to a much healthier 29.2% a year ago.
And just to put that in accessible terms for everyone listening, a 900 basis point drop is substantial. What does that mean in real world pain for the company?
It means that for every $100 in home sales, the company's eating almost $9 more in costs than they were last year. It's an immediate, really painful hit to profitability.
And management's explanation was?
They pointed to increased input costs for materials and specifically the drag from tariffs. They even quantified it. They said tariffs alone were adding about $1,200 to the cost of a standard floor plan.
So immense cost pressures, but volumes were also down.
Right. Unit volumes were soft. Floor sections sold dropped 11.6% year over year, from 475 down to 420. But to their credit, the pricing side is moving in the right direction.
Okay, so a silver lining.
A small one. They are managing to pass some costs through. Net revenue per unit was up almost 8% to $68,500. And that reflects genuine price increases and also a richer retail sales mix.
So the problem wasn't selling cheap homes. It was the volume drop combined with just skyrocketing costs.
That's the 1-2 punch.
But here's where the story gets really bizarre for me. SG&A, selling, general, and administrative expenses went up 20.6% in the quarter.
Yeah.
In a quarter when revenue was declining, what on earth drove SG&A up so sharply?
This is the clearest evidence of the internal chaos that, led to the management change. The increase was from a few specific, large, and critically, hopefully non-recurring items.
Okay.
Management cited three main drivers. First, a $900,000 increase in legal expenses. Second, a $500,000 increase in loan portfolio loss expenses. And finally, additional professional and consulting fees, probably related to cleaning all this up.
A $900,000 legal expense jump suggests more than routine business. It points to that internal turmoil, doesn't it? The CEO, CFO, General Counsel all leaving in October.
That's exactly what it points to. Transition costs, maybe severance, legal fees. The new interim management team explicitly called out SG&A control as their #1 priority, which tells you they believe these expenses are transitory.
But the market needs proof.
Absolutely. That SG&A spike completely wiped out any chance they had of mitigating the margin pressure.
Now, before we pivot to the fix, we should mention their finance division. That's still a solid asset, right?
Oh, absolutely. It's a critical point. Interest income was up over 5% to $10.9 million. The consumer loan portfolio grew almost 13% to $188 million.
And the quality.
Very high. They stressed that 97.5% of those consumer loans were performing as agreed. So that loan book is a high-quality, reliable stream of income. It's the buffer that allows them to make these big changes.
Okay, so let's talk about that change. The prior exec team is out. The co-founders are back in as interim CEO and executive chairman, and they're pushing this back-to-basics approach.
Right. Cost discipline, balance sheet optimization. This is where we need to be a little critical, though. The founders are stepping back in to clean up a crisis that developed under the more recent management. The pressure is intense. The market is asking, can they really deliver this time?
And the first place they targeted for cleanup was a bit surprising. Working capital, specifically inventory.
They were incredibly blunt about this. They basically said their raw material and finished goods inventory, which includes about 200 finished houses just sitting in the yard, is probably double what it should be.
200 finished houses.
Just sitting there. The inefficiency is staggering.
Yeah.
They estimate that just reducing this unproductive inventory could free up anywhere from $10 to $20 million in capital.
10 to 20 million in free cash is a huge number for a company this size. But how do you sell 200 idle houses without resorting to a fire sale? That would just crush your margins all over again.
And that is the management challenge. They hinted they'll use their newly acquired retail channels, which we'll get to in a moment, to push those units through. The goal isn't just to liquidate, though. It's to restructure the whole production flow so this never happens again.
It signals a fundamental disconnect under the old team.
A total lack of production to sales coordination. But getting $20 million in cash back on the balance sheet would instantly change their flexibility.
Okay, so let's shift to their forward-looking guidance, which contrasts pretty sharply with Q3.
It does. They set some aggressive targets. They expect new orders to keep their Texas plants at a typical run rate, 3 to 4 floors a day through year-end. But bigger picture, they're targeting a company-wide production rate of 8 to 10 floors per day in Q4.
And what do they say about profitability?
They explicitly said manufacturing should contribute nicely to earnings in Q4, with Q1 2026 being even better. And on that critical SG&A line, they promised an immediate reversal in Q4.
An immediate reversal. Strong words.
And significant relief expected in Q1 2026. That promise is absolutely key to regaining market confidence.
Okay, let's move to the biggest strategic move of the quarter then. The acquisition. What exactly are they buying with this AmeriCasa Solutions deal?
This is the future of the company, really. It's a complete paradigm shift. It's an all-cash deal valued around $22 million, set to close by November 28th, and it's multifaceted.
Not just a simple storefront.
Not at all. It includes a high-performing Houston retail dealership, which is crucial for moving those 200 inventory homes. It also includes an insurance arm and a really robust chattel loan book valued around $10.8 million.
Can you just quickly define chattel loan book for the listener?
Absolutely. So in manufactured housing, a chattel loan is financing for the home itself, the personal property, not the land it sits on. They're typically higher risk, but also higher rate loans.
And this portfolio?
The one they acquired has interest rates over 16%. So this gives Legg a high-margin lending mechanism that's immediately tied to their retail sales.
They also got something called the FutureHomeX AI-enabled sales platform. Why is a piece of sales tech important for selling manufactured homes?
This is how the industry is modernizing. FutureHomeX lets customers customize floor plans, view virtual walkthroughs, get instant pricing. It just streamlines the whole process.
I see.
The primary goal of the whole AmeriCasa deal is to shift their distribution mix away from low-margin wholesale.
And what are the numbers they're targeting with this pivot?
Management expects it to materially accelerate their company-owned retail volumes. They're aiming for a 50 to 100% increase in retail units sold in 2026 compared to 2025.
And that's all about margin.
It's all about margin. They capture that high retail margin. They estimate it's in the 40 to 50% range compared to the 20% they just reported on the wholesale side. This acquisition is about moving the entire profit profile of the company up the margin ladder.
So if we connect this to the bigger picture, how is Leygate positioned in the macro environment? Housing is still pretty volatile.
It is, and Leygate has materially underperformed the broader home builder ETF, ITB, and the S&P 500 for the last year. But their focus on manufactured affordability gives them a different kind of demand exposure. It's less sensitive to interest rates than, say, a traditional home builder.
And they highlighted a specific tailwind, right?
The major one, Texas's economy, specifically the demand coming from all the new data center construction. Management estimates at least 5,000 housing units will be needed in the next 2 years just to support that workforce.
And those have to come from somewhere.
Right. And most will come from the big manufacturing facilities in Texas, including their own. It's a very targeted industrial demand driver.
Conversely, though, they were pretty cautious about the Southeast, Georgia specifically. What's going on there?
They noted that the traditional mobile home park model is struggling. The high home and setup costs just aren't being offset by proportional rent increases, so it's squeezing investors. Demand there is less structural. It relies more on direct consumer sales or opportunistic things like disaster relief. It's just less reliable.
Okay, one final anchor point before we get to our trade idea. Book value.
This is their margin of safety. The company ended Q3 with book value per share at $21.85, up over 10% year over year.
And management's using that as a signal.
A very clear signal. They said they will use their strong balance sheet and undrawn $50 million revolver to repurchase shares if the stock keeps trading near or below that book value. It's a communicated floor for investors.
All right. Now for the segment where we put on our analyst hats and pitch a high-conviction trade idea. And just to be clear, this is explicitly not financial advice.
Right. So given the stock's steep recent decline and its proximity to that tangible book value, the trade we're pitching here is a long lead short ITB pair trade.
Okay. Long legacy, short the home builder ETF.
Exactly. The thesis hinges on de-risking and internal catalysts. The price action, down 20% over the last month, suggests all the Q3 bad news is fully priced in. The stock is trading right near its tangible book value of $21.85, and it's backed by that share repurchase floor. So the long position gives you a margin of safety.
But the execution risk is huge. How do you hedge the market's deep skepticism that the founders can actually deliver on this SG&A and inventory turnaround?
You short the iShares U.S. Home Construction ETF, ITB. This approach neutralizes your exposure to the broader housing market risk, the high for longer interest rate volatility that hurts the whole sector.
So you're isolating the bet.
You're betting specifically on two internal catalysts that are unique to Leygate. First, that SG&A immediate reversal in Q4, which should drop straight to the bottom line. And second, the successful integration of that FutureHomeX retail pivot, which promises massive margin expansion starting in 2026.
It's a bet on the cleanup and the strategic shift, not the whole housing market.
Precisely.
So what does this all mean for you, the listener? Legacy housing is clearly in a massive transitional period. They are rapidly shifting from a quarter that was just defined by margin pressure and internal chaos toward a founder-led, cost-disciplined, retail-focused model.
And the market is absolutely treating Leygate as a show-me story right now. Investors are demanding tangible proof that those elevated Q3 costs are truly transitory and that the AmeriCasa deal will translate into the tangible profit improvement they've promised for 2026.
It's all about execution credibility for the next 2 quarters.
That's the whole story.
Okay, a final provocative thought for you to consider. If the new management successfully hits its goal of freeing up that $10 to $20 million in unproductive working capital cash management that was definitely not priced into the Q3 results, how quickly would that liquidity be deployed? And what specific impact would that large injection of new free cash have on the existing share buyback program, especially with the stock already trading so close to book value?
That's a great question.
It's a question of capital discipline that we will be tracking very, very closely.